Welcome to the Explainer. Today, we're going to build a mental map of the securities market. That system that seems so complex, but it's really the engine that turns our savings into huge, world-changing projects. We're going to break it all down, step by step, right from the very beginning. So let's start with a really fundamental question. When a company decides it needs to build a massive new factory, or a government wants to fund a new highway system, where does all that cash actually come from? The answer gets right to the heart of why the securities market even exists in the first place. Here's how we're going to tackle this. First, we'll cover why the market exists. Then we'll look at the two key places where all the action happens. After that, we'll get into the two main types of things you can trade, the major players involved, and finally, how it all works in our digital world. Okay, let's dive right in. So what is the core purpose of this entire system? What's the engine that makes it all go? The whole market, and I mean the entire thing, is built on this one concept, a security. It sounds a little complex, but it's really not. Just think of it as a formal contract. It packages up either a tiny slice of ownership, what we call a stock, or a loan, what we call a bond, into something that can be bought and sold really easily. And this is where it gets really interesting. Securities have this crucial dual role. For investors, they're a way to put our savings to work, hoping to earn a return. But for the issuers, the companies and governments, they're a way to raise huge amounts of money for their big ideas. So in short, the market is the ultimate matchmaker, connecting the people who have money with the people who need it. Okay, so if securities are the product, where are they actually created and sold? Well, this all happens in two very distinct arenas. And to make this super simple, let's use an analogy that I think we can all get our heads around. The securities market works a lot like the market for cars. On one hand, you have the primary market. I want you to picture this as the car factory. This is where a company creates and sells brand new securities for the very first time directly to investors. The money from the sale, it goes straight to the company. Then you have the secondary market. This is like a giant global used car dealership. Here, those exact same securities are just traded between different investors. The company isn't involved at all. The money just moves from one investor's pocket to another's. And this table just breaks down those key differences perfectly. The primary market is all about raising new money. The secondary market is about providing liquidity, which is just a fancy way of saying it lets investors easily sell their securities for cash. And that liquidity is absolutely crucial. I mean, think about it. Without the promise of being able to sell later in the secondary market, way fewer people would risk buying in the primary market in the first place. But the most important distinction is right here. In the primary market, money goes to the company. In the secondary, it just moves between investors. Now let's dig into the two most basic types of securities you'll find, equity and debt. They represent two totally different relationships you can have with a company. So the crucial point here is the difference in your role. When you buy equity, like a stock, you literally become a part owner. Your potential reward is getting a share of the company's future profits and growth. But the risk is that the company might not do well. Now, when you buy debt, like a bond, you're not an owner. You become a lender. You're just loaning the company money. Your reward is a preset series of interest payments, and your main risk is just that the company might fail to pay you back. Owner versus lender. It's a fundamental choice. Now, this entire system, with its primary and secondary markets, its stocks and its bonds, it doesn't just run on its own. It actually requires a whole ecosystem of specialized players to function smoothly. You can really think of this ecosystem in three main groups. First, you've got the capital seekers, or the issuers. Those are the companies and governments that need the money. Second, the capital providers, or the investors. That's everyone from individuals like us, also called retail investors, to massive institutions like mutual funds and pension funds. And third, you have the facilitators. These are the stock exchanges, the brokers. They're the ones who build the roads and the infrastructure that connect the other two. So how does all of this stuff actually happen in the 21st century? Well, you can forget about those old images of crowded trading floors with people shouting at each other. Today, it's all about going digital. But it wasn't always this easy. Back in the day, owning a stock meant you literally held a physical, fancy piece of paper called a share certificate. And you can just imagine all the problems that came with that, right? They could be lost, they could be stolen, they could be forged. And just trying to transfer ownership was this slow, manual, painful process. But today, a process called dematerialization has totally revolutionized the system. It's a big word for a really simple idea. Those physical certificates are converted into an electronic form. These digital records are then held in a super secure central vault called a depository. Just think of it like a bank, but for your securities. And this allows ownership to be transferred instantly and securely with just a few clicks. And the benefits of going digital are just enormous. It completely eliminates the physical risks of theft and forgery. It allows trades to be settled almost instantly. And for all of us investors, it gets rid of tons of paperwork and makes tracking our investments incredibly simple. This is what created the efficient and accessible market we know today. So when you put it all together, from its core purpose of connecting capital with big ideas to its two different markets, its main products, and its modern digital backbone, you really start to see the securities market for what it is: a powerful and complex engine for turning the savings of many into the economic growth that can benefit everyone. So we've just built the foundational map of how this entire world works, but the key takeaway isn't just about knowing the definitions. It's about thinking about what this all really means. This system powers our entire global economy. So the final question to leave you with is this: how could a better understanding of it power you?